Imagine spending your entire working life building a pension, and believing that whatever you don't use can eventually pass to your children. But for deaths on or after the 6th of April, 2027, that assumption changes. From that date, most unused pension funds and pension death benefits will be brought into your estate for inheritance tax purposes. So what happens to your pension? Is it still protected? And how much could your family actually lose? For some affected families, the difference could be tens of thousands of pounds. Because the amount your family ultimately loses may depend on how much unused pension you leave behind and what else is already in your estate. Here's the uncomfortable part. You could have done everything right. Saved for decades, built a substantial pension, left it untouched. And your family could still face a larger tax bill because of it. But does this affect your pension at all? Because not everyone with a pension will be affected in the same way. There are also important exceptions, including certain death-in-service benefits and dependents' pensions. The exact treatment can depend on the type of benefit and the pension scheme, so I'll explain those exceptions in the body of this video. In the next few minutes, I'll show you exactly who could be affected, how much could potentially be at stake, and the one thing UK pension holders need to understand before 2027. And this isn't a rumour or a proposal. The change is already legislated. The Finance Act 2026 contains the relevant provisions applying to deaths occurring on or after the 6th of April, 2027. Your pension is no longer automatically outside the inheritance tax conversation. If you want to understand the money rules changing in Britain before they affect your family, subscribe to the Wealth Code. Because the most expensive financial mistakes are often the ones people don't discover until it's too late. And if someone in your family has a large pension, send them this video, because this is one rule they may genuinely want to understand before 2027. And if this helped you understand what could otherwise be a very confusing change, give the video a like, it helps us reach more people who need to know about it. So, what actually changes on the 6th of April, 2027? Under the new rules, most unused pension funds and certain pension death benefits will be included when your estate is assessed for inheritance tax. In simple terms, your pension could now count alongside things like your home, savings, and other assets when the estate is worked out for inheritance tax purposes. But there's an important point. This does not mean every pension will suddenly be taxed at 40%. Most estates will still pay no inheritance tax at all. The real issue is whether your total estate, including the unused pension, becomes large enough to create an inheritance tax bill. And that means the size of your pension could matter much more after the 6th of April, 2027. Because two people with exactly the same pension could end up in very different situations, depending on what else they own. So, who should actually be worried? Not everyone with a pension. The key question is how much your family inherits from your whole estate, including any unused pension. From the 6th of April, 2027, most unused pension funds and relevant pension death benefits will be brought into the inheritance tax calculation, while qualifying death-in-service benefits from registered pension schemes remain excluded. And remember, most estates will still pay no inheritance tax. But if adding your pension pushes the value of your estate above the available tax-free allowances, your family could face a larger tax bill. And that's the part many pension holders may not realize. It's not just your pension anymore. It's your pension, plus everything else you leave behind. So, let's put that into real numbers. Here's where it gets real. Imagine you leave behind £500,000 in other assets and £300,000 in an unused pension. Under the rules applying before the 6th of April, 2027, that unused pension would generally sit outside the inheritance tax calculation. From the 6th of April, 2027, it can be included. For inheritance tax purposes, your estate could now include the extra £300,000. And if that pushes your estate above the available tax-free allowances, your family could face a larger inheritance tax bill. But remember, the pension itself isn't automatically taxed at 40%. It's the overall estate that matters. So, the real question is, how much extra tax could that create? For example, if the full £800,000 estate had only a £325,000 nil rate band available, the taxable amount would be £475,000. At a 40% inheritance tax rate, that could mean a bill of £190,000. That is only a simplified illustration. The actual result could differ depending on factors such as the residence nil rate band, whether it applies, who inherits the assets, and any other available reliefs or exemptions. But the key point remains: including the pension could increase the taxable value of the estate and, in some circumstances, create a significantly larger tax bill. And that one change could make a significant difference to families who've spent decades building both property and pensions. But there is an important exception you need to know. Not every pension-related death payment will be pulled into inheritance tax. For example, death-in-service benefits paid from a registered pension scheme will remain outside the estate for inheritance tax purposes under the 2027 rules. So don't make the mistake of hearing pensions are being taxed after death and assuming every pension is affected in exactly the same way. The new rules mainly target unused pension funds and certain pension death benefits. And there's another reason this matters. The government estimates that around 38,500 estates could pay more inheritance tax, while around 10,500 could face an inheritance tax bill where they otherwise wouldn't have. So the question isn't simply, do I have a pension? It's, what will my pension mean for the total value of what I leave behind? And that's where the numbers really matter. So, what should you actually do? Don't panic, and don't rush to withdraw your pension simply to avoid inheritance tax. The new rules are real, but the right decision depends on your circumstances. The important thing is to understand how much you have in your pension, what other assets you own, which inheritance tax allowances may apply, and who you want to leave your wealth to. And there's another important change. From the 6th of April, 2027, personal representatives will be able to instruct pension scheme administrators to withhold up to 50% of certain pension benefits when they know or have reason to believe inheritance tax may be due. The withholding mechanism is not intended to be used routinely or simply as a precaution. So, this isn't simply a case of, I die, and HMRC takes 40% of my pension. That isn't how it works. The rules are more complicated, and that's exactly why understanding your position before 2027 matters. The goal isn't to panic or make a rushed withdrawal. It's to understand your position while you still have time to make informed decisions. There's one mistake you should avoid. Assuming your pension is automatically protected from inheritance tax. From the 6th of April, 2027, most unused pension funds will generally be brought into the estate for inheritance tax purposes. But don't make the opposite mistake either. Don't empty your pension just because you're worried about tax. The smart move is to understand your pension, your other assets, and the inheritance tax allowances that may apply to your estate. So, before 2027, work out the value of your pension, your other assets, and the allowances available to your estate. Because the question isn't, will HMRC take my pension? It's, what will my family actually inherit after all the rules are applied? That's the number that matters. And this brings us back to the question we started with. Is your pension really protected after you die? From the 6th of April, 2027, most unused pension funds will be brought into the inheritance tax calculation. The government expects tens of thousands of estates to be affected. The key takeaway is simple: your pension may have been built for your retirement, but from 2027, it could also play a much bigger role in what your family inherits. So, make sure you understand the rules and know what they could mean for your family. If this video made you look at your pension differently, give it a like. It helps more people discover this information. And if someone in your family has a substantial pension, send them this video. They may want to understand these changes before 2027. Then subscribe to the Wealth Ledger, where we break down important UK money and tax changes in simple language, without the complicated jargon. Your money. Your family. Your future. Understand the rules before the rules affect you. And remember, it's not just what your pension is worth. It's what your family actually gets to keep.